You nailed it. Those are the two big catalysts, potential catalysts for things to get better here in terms of market reactions. I think the good news is you do get some relief on both those fronts. On the China front, some relief from Fed tightening, but you're only going to get that next year. I think we have to keep our eye focused on the big picture, which is that we're navigating a period of slowdown in the global economy. So global growth went down to trend very quickly. We're navigating a deceleration in the U.S. economy from 4% back down to trend at some point next year. And it's hard to get bullish, and very bullish in particular, until that's in the rearview mirror.
So are you pulling back on risk in the portfolios you run? And if so, how?
I think you need three things. You need caution, you need carry, and you need a good insurance policy. So caution means reining in those positions, from what was a very long equity position at the beginning of the year, playing it closer to neutral. Carry, insofar as we don't view this as being over by any means, right? So recession risk is still low, even against the backdrop of that decelerating economy. And so we reserve the right to become more bullish in the future here. We don't think it's over. And insurance policy is that you want things that hedge against the key risks right now. You have growth shocks just coming from the data that we're seeing. You have potential inflation shocks. You have policy shocks. All that suggests a bit more balance of an approach between equities, duration, or bonds, and cash.
Let me turn to you, Kevin, if I might. It seems like such a short time ago, weeks, if not months, or months, if not weeks, where we were talking about synchronized global growth. Everything was coming up roses, and U.S. growth was very good. Now we're talking about global slowdown and a slowing of U.S. growth. The roses have turned to mushrooms. How did it happen so fast?
Well, it's the nature of things. If you think about past cycles, late 90s was a fantastic time, turned very quickly. Before the financial crisis, things were very good before it turned very quickly. And the key to this whole thing has to do with sentiment. So it was 9 months ago, maybe 12 months ago, where all people I talked to wanted to talk about were things like, do I buy Bitcoin? Is it going to go higher, et cetera? There was a real sense of risk-taking a year ago. We were also looking at the tax policies being changed. That was a big impetus to the forward look. But today, things have kind of changed a little bit, and we saw it start to slow down in February. We've been cutting our equity exposure since then, and things are now looking more difficult, particularly overseas. The United States is still fairly good, but the cross currents coming from overseas, maybe having something to do with trade, has really upped the really dampened risk enthusiasm and created some more risk.
Let me squeeze in one more question there, if I might. Are we the cleanest shirt in a dirty pile of laundry, or are we really a clean shirt?
No, we're really a clean shirt. I mean, things look very good here. If you look at corporate profits, they're very strong. If you look at confidence, it's pretty good. When you look at employment, is pretty good overall. But in the last month, we've seen the capital markets start to push back. We've seen some flattening of the yield curve, global stocks underperforming global bonds. We've seen some widening of credit spreads. We've seen commodity prices come off. So month after month after month this year, it's just been kind of a steady erosion. This last month, though, has been a sharp difference. And I think that has been what's caught a lot of traders by surprise. But you got to really be focused a little bit more defensively, and we've been moving to more defensive postures in portfolios starting back in February, March of this year because of what we're seeing. Yeah.